As we approach year end, there are a number of financial moves you must execute before the end of the year, and a few others that make sense to consider for financial planning purposes. In this video, I am outlining the top 10 moves to consider before year end. So let's get into it. Number one, and not a big surprise, max out retirement plan contributions. Review those contributions. If you haven't made the annual maximum and have extra cash, you can increase your contribution deferral from your paycheck at the end of the year. Maximums often change from year to year, so be sure to review what they are. And if you're over 50, don't forget about the extra catch-up contribution that can really supercharge your annual contributions. A lot of people forget about them, especially people that just turned 50. So remember that one. And if you're in a lower tax bracket, say under 30% or so, I would strongly consider the Roth 401k if it's available to you. Additionally, now is a great time to increase your retirement plan contributions for next year. A great strategy if you're not already maxing out your retirement contributions is to increase them by 1% each year. It often results in just a small increase in forced savings that you may not notice, but your future retired self will be very happy. And even if you are maxing out your contributions, by increasing the contribution percentage, you get more into the account earlier in the year, potentially supercharging that tax advantage growth. All right, number two, max out the health savings account. I love HSAs. Health savings accounts are available if you are participating in a high deductible healthcare plan and can be extremely powerful building tax advantage savings for retirement. Get a tax deduction today, tax-free growth over time, and tax-free distributions if the funds are used for a wide array of medical expenses. Everything from long-term care premiums to eye drops counts as a medical expense. All right, number three, build up that emergency fund. A minimum of 4 to 6 months of necessary expenses like food, your rent or your mortgage, utilities, medical and child costs. Set them aside in a high-yield savings account with FDIC insurance, no fees, and easy accessibility if you ever need it. It can provide a peace of mind if hits the fan, which it sometimes does. And remember, these high-yield savings accounts are not often at brick and mortar banks. They're often online banks. Next up, consider a solo 401k plan if you own a small business. While other retirement accounts like SEP IRAs and Roth IRAs can be open next year up to your tax filing for contributions this year, the solo 401k must be open before the end of the year to be eligible for current year employee deferral contributions. Next up, revisit your cash and bond positions. After years of little to no interest on most bonds and savings, many savings accounts and bonds are now paying attractive rates of interest. It may be easier to achieve moderate returns with low risk based on current interest rates by shifting some assets. Next up, consider a Roth conversion. While Roth IRA contributions can be made for this year up until you file your taxes, Roth conversions must be done this calendar year. Yup, the deadline for Roth conversions is December 31st. Conversions, remember, would be taxed at current year tax rates, which are relatively low and could rise in the future. So I would explore whether they make sense in your situation before the end of the year. All right, remember to take your required minimum distribution from your IRA or 401k. When you reach age 72, you are now required to take a portion of your IRA or 401k proceeds from the account. Now you can choose which IRA or 401k account to take the distribution from, or you can take it from each one. The amount you're required to take varies depending upon the account value and your age. But don't forget, because the IRS penalizes you 50% on the amount of funds that you did not take out. My next year-end strategy: review opportunities to harvest paper losses to offset capital gains and income. The silver lining of an investment that is down is that it can be sold and used to offset capital gains and up to $3,000 of income. Tax loss harvesting, as it's called, only requires that you remain out of that security for 30 days to avoid what is called the wash sale. After the 30 days is up, you can buy back the sold investment and reset your cost basis. Too many investors miss out on this tax planning play, so make sure you review it. And if you own mutual funds or inherited mutual funds, they often pay out capital gains distributions in December. If you have a paper loss or a small gain in the mutual fund and they are set to make a substantial taxable capital gain distribution, it may make sense to sell the fund before the distribution is paid in order to avoid it. You'll have to do your research to find out which funds are paying distributions and when. All right, next up, realize capital gains if your income is lower this year. The rate that you pay on capital gains varies based on your income. If your income is artificially low this year for some reason, it may make sense to realize some gains, especially if you qualify for the 0% capital gains tax. Just Google capital gains tax brackets in order to find out where you fit. Next up, run cash flow projections for next year. This is a really good idea, especially if you love spreadsheets. But even if you don't, it's still a great idea for planning for the next year. Running cash flow projections is important for expense planning. It's also important for tax planning. If there is a shortfall in a month, a quarter, or for the year, if you're retired, now is the time to determine which investment accounts that you should make distributions from in order to minimize taxes and potential Medicare IRMAA surcharges. Now look, not every one of these 10 financial moves may apply to your financial situation, but my bet is that at least a few of them do. Hopefully this is a nice reminder that can help you see the forest through the trees. And if you want to learn another tip, you should check out this video next to supercharge your financial life.